Hey guys, what is going on? Welcome back to my Robinhood portfolio. What I thought I'd do today is talk a bit more about taxes. A lot of you guys have been inquiring about tax implications for investing on Robinhood, for investing on the stock market in general. So I thought I'd just kind of quickly go through and recap some of the important tax implications that investing has for you at the end of the year. I did put a couple videos out about 3 or 4 weeks ago, one discussing preferred dividends and taxes, and the other one describing taxes incurred with capital gains. That is, buying a stock low, selling high. That difference, that profit made, also is subject to income tax. So I put a video about capital gains and a video out about dividends, preferred dividends. To quickly recap here, I'll just kind of quickly go into detail about each of those. So for dividends, essentially you need to pay ordinary income tax on dividends if the company that pays a dividend is held for less than a year, and then you can pay preferred dividends if the company is held for greater than 1 year. And as you guys remember, there are a number of different income tax brackets. The lowest $0 made to $9,275 is a 10% tax bracket. If you make over $415,051 per year, you're in the 39.6 tax bracket. And in between, there are a number of different ones: 15, 25, 28, 33, and 35. So essentially, you have a stock you have held it less than a year, it pays dividends. You have to pay the corresponding income tax rate. But if you've held that company over 1 year, you can pay preferred dividend rate. So if you're in the 10% tax bracket, instead of paying 10, you pay 0. If you're in the 15, you pay 0. If you're in the 25% tax bracket, you pay 15. And that goes for the 28, 33, and 35% tax brackets as well. And then if you fall into the 39.6% tax bracket, you pay 20%. So pretty simple to understand. So less than 1 year, dividends paid, you need to pay ordinary income tax 10, 15, 25, 28, 33, 35, or 39.9%, depending on which tax bracket you fall into based on income, ordinary income. But if it's preferred, the 10 and 15 goes to 0, the 25, 28, 33, and 35 goes to 15, and the 39.6 goes to 20. So you can see there a substantial tax savings. And the same goes for capital gains. So for capital gains, if you've held a stock for over a year and then sell it, you basically, again, reduce all those income tax rates, the same ones for the dividends, down to the same ones for the preferred dividend for capital gains. So kind of an easy concept to understand. Essentially, it pays for buy and hold strategies. So you can do a lot of day and swing trading, but you're essentially saving quite a bit of money. For example, if you're in that 39.6% tax bracket, you're dropping from that to 20%. So right off the bat, with doing absolutely nothing, you are saving 19.6% in taxes, which for every $100 you've made 19.6% rate of return there, return on income. So that is, return on investment. So that is a huge tax savings. You can see why there are so many investors that do the buy and hold strategy. Capital gains as well. If you hold the company and then sell after a year, again, without doing anything other than selling it, you just made 19.6% rate of return on investment. So a very, very significant tax savings for both dividends and capital gains. That's why I propose doing buy and hold strategies over more risky day and swing trading. Although you can make a lot of money day and swing trading, a lot of investors prefer just to get the preferred tax rates for both preferred dividends and for capital gains. And then you may think, well, there are a number of ways to kind of game the system, if you will. So at the end of the year, capital losses can be taken out. So it's basically net income. So if you've had a stock, you bought it for 10, sold it for 110, you made $100 per stock. So you'd have to pay, income on that $100 made. But let's say for another stock you bought at 100 and you sold it for 10, or excuse me, let's say you bought it for 110 and you sold it for 10, you lost $100. So those two would offset, and at the end of the year, you'd essentially have to pay zero tax because you made $100 profit, you lost $100 on another stock, so it's 0%. So a lot of investors try to do that at the end of the year by selling off stocks that they've lost money in. But there is another rule called a tax wash. Excuse me, it's not a tax wash, it's basically a wash sale. So you can't go ahead and sell off a stock for a loss and then buy that same stock back, or a corresponding stock, one that is very similar to that company you sold. So it kind of gets around, investors trying to game the system by selling off a lot of losses at the end of the year to reduce their tax burden. And that kind of goes for dividends as well, dividend paying companies. You can't simply sell off a company for a loss and then buy it back to get that offset with the capital loss offsetting the dividend payment. So a couple of different tax things to take into consideration for dividends and capital gains. I hope that was clear. Like I said, I did put out a couple other videos that go into much more detail regarding both of these. So if you have any questions, take a look at those first, and then feel free to ask me questions. The whole point of these videos, as I always say, is to learn. So if you guys have any questions about anything I've said, let me know. If there's any better insights or anything I said incorrectly, let me know as well. I'm a new investor learning, so any insights are very, very helpful. So kind of with that, I'll end the video. As always, if you enjoy my videos, feel free to like, share, and subscribe. The whole point of these videos is to learn. I hope you guys are learning a little bit from my videos. And as always, if you guys have a good question or topic to talk about, let me know, and I can do a video about that. Any good investing strategies or stocks, I'm always looking for new opportunities, so let me know as well. So kind of with that, I'll end the video, and we'll see you guys later.